Hello and welcome. This is video number 5 in a 6-part series about the post-World War I world. And in this video, we're going to talk about the conditions that would ultimately lead to a global depression that really began to find its way around the world in the early 1930s. So with that, we'll get started. All right, so with global depression, the way we're going to look at this is really in 2 parts. And in the part today, it is going to focus on what caused this to happen. And so what we'll start with is the reality that the U.S. economy was the key to the global economy by the late 1920s. And that basically, if something bad happened to the U.S. economy, the rest of the world was going to be very likely to feel that too. All right, so what I want to start first with is just to identify some of the U.S. economic problems that existed, because despite the fact that the 1920s appeared to be really fantastic, and in many ways it was for the American economy, there were definitely some flaws or definitely some issues that were under the surface, maybe not particularly evident, but they were there. So in talking about this, again, the U.S. economy appeared to be very strong during much of the 1920s. Production was high, the stock market was booming, and that's one indicator of a good economy. But unfortunately, there were a lot of flaws, despite a few obvious positive indicators. Now, the reality was American factories produced about half of the world's industrial goods, which led to a lot of profit. About a third of that profit ended up going to about 5% of the population. So a fairly small number of people did become quite wealthy off of what was going on throughout the 1920s. Nearly 2/3 of families in America earned an amount of money that would put them at or below what we would call the poverty line today. Now, the reason the distribution of this income mattered is that a majority of the population didn't really have enough money to buy very many of the goods that were being produced. And what this would ultimately lead to in time is that less goods could be bought, and that meant that less goods would end up being produced as the 1920s went on. And with less goods needing to be produced, that led to workers beginning to be laid off, which meant that people that already didn't necessarily have a lot of money ended up finding themselves out of work and then having even less money. And so this ended up creating over time a really negative downward cycle. One of the things that happened also during this time that created some challenges was that people with little money who did need things were making purchases on credit. And what this meant at the time is that people would pay a little bit up front for something that they wanted or needed, and then they would make payments to pay for the rest over time. It's not quite the same way as the way we use credit cards today, but it's the same concept that you're getting a purchase and you're getting that purchase in your hands without having at that moment yet paid the full price for that product. And one of the things that became challenging as the 20s went on is as people started losing their jobs, the ability to make good on those credit payments started to go away. And so people who lent money started to not get that back. And so that started to create trouble, not only for the people who were borrowing and ending up with less money, but the people who were lending ended up not getting what they were expecting to. Now, we talked about improvements in agriculture in some earlier videos representing an earlier time in this class. And by the 1920s, a lot of those agricultural improvements meant that there had been pretty dramatic increases in food production, which is good. As far as in terms of having food for people to eat, there was plenty to eat. The problem that began to emerge, though, is that with so much food being produced, there was a major surplus of a lot of agricultural products, and that drove the price that farmers could sell those agricultural products down. And farmers, as time went by, found it harder and harder to make money selling their crops. And one of the ways that this created a challenge beyond simply farmers not making as much money was that they often have to borrow money from a lending institution in advance of a season to get the supplies they need to be able to plant and go through the upcoming season. with crop prices dropping, and in some cases dropping pretty dramatically, a growing number of farmers were not able to repay their loans. And so as that began to happen more and more, that became a big problem for banks and other lending institutions that relied on those repayments to be able to operate. So overall, even though as you looked at the 1920s as a decade, there were a number of good things going on, there were definitely some issues below the surface, and those would in time contribute to a global depression. The next thing I want to speak to is the stock market crash. This is not the only reason that there was an economic depression, but it's definitely something that gets a lot of attention. So I want to speak through just a few of the basics of what the stock market represented, and how it worked, at least in the context of contributing to some challenging times getting into the 1930s. All right, so buying stocks is one example of investing. People will buy stocks in the hope that they can sell them later at a profit. And when you buy a stock, it represents part ownership in a company. When stocks are bought, the company is able to get money to work with for their business. That's why businesses will sell stock. If businesses succeed, the value of that stock tends to go up. And if you are an owner of stock, there are a couple ways that you can earn money. One of the ways that you can potentially earn money is off of dividends. Sometimes from a stock, when you have a certain stock, dividends are paid, which dividends represent a small payment to a stockholder that might be available if that company is profitable. The other main way to earn money is to sell the stock that you at one point purchased at a price higher than when you bought it. And what can be tricky is that stock prices may or may not reflect how profitable a company is, and their value may suddenly change, and possibly for the worse. So there's certainly a risk when you buy stocks. Now, in the 1920s, the stock market was booming. Stock prices were steadily going up as the decade went along, which led to people that didn't normally buy stock, in some cases, trying to purchase them. It's important to remember very few people actually bought stocks at this time, but a higher number of people began to as the 20s went on. And one of the ways this worked for people that didn't necessarily have as many resources but still wanted to purchase stocks is they would buy those stocks on margin, which just meant that they paid a portion of the stock's price to a stockbroker, and then that stockbroker would lend them the rest of the money for the purchase. Now, as long as the stock prices went up, this was no problem because they were going to need to pay that stockbroker back at some point, and presumably that would happen after they sold their stock for a higher price than what they had originally paid for it. By September of 1929, a growing number of people began to sell their stocks because they began to feel like prices had gotten so high they just couldn't go any higher. And as a growing number of people wanted to sell and fewer people wanted to buy, this led eventually to a panic as prices started to go down, really for the first time in years. Since nearly everybody wanted to sell their stocks and hardly anybody wanted to buy them, the prices would actually drop like crazy, and they would hit a new low on October 29, 1929. Now, that's a day that's noted as a stock market crash day. Nothing real changed that day. It's not like businesses evaporated into thin air or anything like that. But the wealth that people had on paper did evaporate for people who had a lot invested in the stock market. And this was especially true for institutions like banks that relied on investing in things like the stock market to make money. So this would become a problem for a lot of different people in a lot of different strangely connected ways. Now, the last thing I want to speak to briefly is moving from this kind of focal point event, the stock market crash, to the actual depression that would take place. So depression in this context refers to an economic depression. And you can get into some technical ways to define it, but to keep it fairly simple, for our purposes, an economic depression refers to a prolonged economic downturn lasting 3 or more years. So basically think things in the economy, indicators in the economy trending down for 3 or more years. So one thing I do want to emphasize is that the stock market did not cause the depression. Really, it was just a loud and obvious symptom of a sick economy. After the crash, however, a lot of people who owed money to lenders couldn't pay them back. People who owned stocks essentially found them worthless. And as a result, even less goods were produced and more people ended up losing their jobs, and what people could earn steadily went down. By 1932, when we get to the point where we say, wow, this is an economic depression. Factory production in the United States was about half of what it had been in 1929. So really kind of think the need to have half as many workers as had been true just a few years before. Many banks closed, and by closing, that means they ran out of money and went out of business. And this was before there was any kind of insurance program like we're familiar with today for banks. So when a bank closed, if you had money in that bank, your money was simply gone. By 1933, about 25% of Americans who tried to find a job couldn't find one. And what may have started in America, because up to this point we're just focusing on America, would end up having an impact around the world. And so what I'll get into in the next video is to talk about how people reacted to this. How did America react to these economic problems, and how did that end up affecting the rest of the world? And it's at this point I want to go ahead and leave it here for now. I hope you'll join me in the next video where we'll look at the impact of these economic problems of the early 1930s. Hope this has been helpful. Thanks for watching.